Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, the show gets you actionable insight on everything mutual fund related. And today, the first part of this conversation is going to give you insight on how fund managers view the current market dynamics, and also will give you insight on how a very popular scheme is currently looking at the market. Joining me at the start is Raj Mehta, fund manager at PPFAS. Raj, thanks so much for taking the time, and pleasure having you on the program. A lot of people are looking toward you for guidance and also to try to understand what your thought process is when you're looking at the kind of swings that we're seeing in the market and the drawdowns that we're seeing. So if you were to look at the market and how it's behaved over the last few weeks, what stands out to you?
Yeah, firstly, thank you for having me on the show. Our view on the markets for the last few months has been that it is in the relatively overvalued zone, and hence it's really difficult to find attractive opportunities to buy into this market. And cash has built up over a period of time. So if you look at the cash levels as on the last month end, it's around 18 to 19% of the portfolio for the FlexiCap, and similar levels for our tax saver fund as well. So it's really hard to find attractive opportunities at this point in time, and hence this cash buildup.
That's exactly part of what I want to talk to you about, because we've been talking about this cash buildup for a few mutual fund schemes, and yours has stood out because so many people track your scheme as well. Is that you've done this in the past and you've done it on strategic occasions in the past. In retrospect, it has always panned out that it has worked in your benefit. What, according to you, are the key reasons why you've done it in the past when you've had similar cash positions?
Sure. So our investment style has always been that we don't force ourselves to remain invested at all points in time. Whenever we feel that the valuations are stretched, and we are not able to find attractive opportunities, we are happy to remain in cash as well. We look at cash as a balancing figure in the portfolio. So if we find any attractive opportunities today, tomorrow, happy to deploy it. If we are not able to find, happy to keep it in cash and wait for the opportunities to come by. So if you mentioned a couple of occasions where we have had cash built up. So just to mention a couple of them, in late 2017 or early 2018, when the mid-cap rally was at its peak, we had about 30% cash in the portfolio. It was not to do anything to do with the Nifty levels, but it was to do with lack of opportunities in the market to deploy this cash, and hence we had built up this cash. And once that mid and small cap rally peaked out, we were able to find opportunities in the mid and small cap space and deployed that money immediately. Similar buildup was seen in the COVID times when cash levels were at 12-13% in March of 2020. And just in 15 to 20 days time, we are able to deploy almost all of it, and the cash levels came down to 2 to 3% of the portfolio. So that helps in downside protection, that helps in minimizing drawdowns, and that helps in risk-adjusted returns over a longer period of time.
Raj, but I'm just curious what you have to say about, and of course, and nobody's asking you to justify moves in the very short term. I'm just curious what your response has been to the 6.7, 6.8, or more than 6.5% fall in the benchmark, more than 7% fall in the broader markets. I'm talking about the small cap. Has that provided you with any opportunities to deploy some of the cash that you accumulated, and that, as you pointed out, stood at what, 18, 19% at the end of September?
Not yet. So not yet able to find the valuations to be in our zone as of now. Probably a few more rounds of correction, be it time correction or price correction, and maybe we'll be able to find some opportunities. So not at the moment, but maybe in the future.
I'm just delving a little deeper into this cash strategy, because I think a lot of debate has happened already, and it's great to talk to you in person about it. Because the criticism of this strategy has been that while valuations have been uncomfortable for some time, and therefore, from your perspective, it's not appropriate to deploy the cash, they've not changed. And in fact, if anything, they've gotten even more stretched. And so as a result, you've not been able to participate in a broad-based bull run, because I looked at the cash position last year also, it was pretty elevated, Raj. I mean, it was in double digit last year as well. So in that time frame, you've seen a run up in equities. And so to that extent, you've missed out on the opportunity that the Indian equity markets have provided. What do you say about that?
So that's correct. So we have always communicated it to our investors that in raging bull markets, we'll probably underperform the markets, and maybe in the short term we will underperform. But over a longer period of time, I think that once we see a drawdown, maybe we'll be able to, beat the markets by a decent number. So if you see 1 week back, maybe we underperformed the benchmark, but in a week's time, we have been beating the benchmark now. So it's just a matter of time of short-term underperformance. We are okay with it as long as we outperform over a longer period of time on a risk-adjusted basis.
That's a fair point. And I guess more important than anything else, and really the conclusion of all of these conversations, Raj, is as long as your investors are aware of the strategy that you're employing, they are going to be okay with it, because your performance speaks for itself, really. And I think we can put the matter to bed with that. But I'm curious about what you've done in terms of the sector rotation. And I've looked at the portfolio construct as of the end of September, and I've compared it with a year back. And I see in terms of sector, you have a significant change in banking, in power, and a certain amount of a change in gas transmission, agri. IT has decreased very substantially. Can you take me through the sector rotation that you've undertaken in the fund?
Sure. So we look at companies on a bottoms-up basis, irrespective of the sector that it is a part of. So most of these changes have been on a bottom-up basis. Private sector banking, of course, has underperformed over a 3 to 4 year period now, and remains to be in the reasonable valuation zone in a market where it's hard to find opportunities. So that's the sector where we are upbeat on, and hence the weightage has gone up to around 20% in private sector banks altogether. Power is a space where we like. We feel that India has remained underinvested, especially on the thermal side. Renewable hasn't picked up to the expectations that everybody had, and hence, at least in the next 3 to 5 years, we don't see thermal going anywhere. So we have a couple of PSU names in the power sector. IT, so we haven't sold any IT names. It's just that we haven't added because the valuations have creeped up in the past year. So with the increase in the AUM, we haven't added incrementally to the IT names, and hence the weightage has come down.
Okay, that's a fair point. I also looked at a substantial fall in the overseas equity. Now, this is also a conversation that has been often had, Raj, but just to drive home the point, it stands, and correct me if I'm wrong, it stands at only about 12% right now, down from what, 16% even a year back. And this is at a time when the companies that you hold have also done quite well. So the underlying has actually gone up. Can you explain why it, and one of the big draws, Raj, for those who remember the management of the fund from the years prior, before all the restrictions came through, is 27, 28, nearly 30% allocation to international. So this is a far cry from that.
Sure. So we would have liked to have added to those positions, but the problem has been that the whole mutual fund industry has been hit with a industry-wide limit, which is $7 billion. So we cannot remit any additional dollars, and that limit has been exhausted for 2.5 years now. SEBI and RBI are working on it, but they still haven't raised that limit. So because of which, what has happened is that all the inflows that have come in the last 2.5 years have been incrementally only deployed in Indian stocks. So because of which the foreign percentage has come down from 30% to about 13%. So we haven't sold any of it. We would have liked to have added to those names, but we have to play within the rules that the regulator set for us.
I've also noticed the addition, Raj, of certificates of deposit to the extent of what, 3.5 or 3.25%. What's the thinking here? Short-term debt?
As you rightly mentioned that we have had cash for the past year or so. So given that most of the cash is deployed in either overnight money or arbitrage or short-term debt paper. So depending on the spreads that are available, either on the arbitrage side or in 1 year short-term debt, depending on the spreads that are there, we try to move the cash between these segments. So it's an alternative to cash, given that overnight money was at 6.5, 675 levels, and short-term debt was 7.5 levels. We thought that it was better if we put it in short-term debt, and it's equally liquid, so not that much of a problem.
So two possibilities that could potentially change your mind, I would think, on deploying funds. One would be if earnings far outshoot what was expected, and so therefore valuations relatively look cheap, or valuations correct. The latter might be more likely than the former, but what factors need to be, or what factors would you need to see play out for you to start deploying in a strategic manner?
Most likely that the second scenario will play out. Whether it's a time correction or a price correction, that is a question that needs to be asked. We have seen some numbers coming in for the second quarter, which were a little soft. The demand has been soft on the rural side. On some of the MFI space, we have seen two-wheeler numbers coming out. Consumption numbers have been a little weak. So yes, maybe the earnings slow down, and because of which there's a PE derating that happens, or maybe the earnings remain at these levels, and the re-rating, the PE re-rating which was happening, that cycle stops, and we may have a longest period where the valuations don't go up and they stay over there. So a time correction is also possible.
Raj, thank you so much for taking the time. Pleasure having you on the show, and season's greetings from all of us here at NDTV Profit to you, your family, and the team.
Thank you so much. Same to you.
All right. Let's talk about this a little bit more in detail. And incidentally, we're joined now by Keertan Shah, founder and chief executive officer at Credence Wealth. Thanks so much, Keertan, as always, for taking the time, and season's greetings to you as well. Welcome back. As I understand it, you're coming back from foreign shores, and the first conversation that you're having with me in a while. So I do want to talk about the cash positions, and we have spoken about it at length in the recent past, but I'm curious what you have to say about that. And also there's some data that we pulled up about the relative outperformance / underperformance of small cap actively managed funds since the 27th of September, very short term period. But there has been an outperformance relative or relatively less under loss of value compared with the benchmark for all but three in the sector. Does that tell you that these fund managers have read the signs much in advance and have already allocated based on that?
Alex, thank you so much for having me on the show. It's always a pleasure. And greetings to everybody who's watching us and the entire team. Alex, I have a very different view. I actually belong to the camp who believes that as a fund, you should try and avoid taking cash calls. The data that you just spoke of is very short term for us to really be able to draw any conclusions out of it. Because if I have to just give you a counter data to that, I see a lot of these funds have been standing on cash for over 3-4 quarters. And just in the last 1 year, just at the Nifty levels, we are up close to 30%. So there has been a significant underperformance also. If at all you've been standing cash for such a long time and the markets have gone up so much. And whenever you talk about taking cash calls, it is like timing the market, right? You are saying that markets are expensive. I don't want to deploy new cash at this point in time. And the cash is not only the cash that you have right now, but the incremental cash that you keep taking in as lump sum and new SIPs. Now, as a fund, you are taking a call that probably markets are expensive. I will not deploy at this point in time, which is a timing call that you are taking, and you've got to be right on two fronts. First is when you don't deploy, the markets don't go up, because if the markets go up, then you're losing out on the opportunity. And when the market starts correcting, at what point in market do you really want to enter? Is a 5%, 6% fall a good fall to enter? If yes, do you deploy everything? So there are a lot of moving elements. I'm sure fund managers are far more better at doing this versus probably a retail investor. But I think as a fund, if your objective is very clear that you will stand cash, then it's okay. You can take cash calls because you mentioned that in your objective. But as a fund, if that's not your objective, I think you should avoid taking cash calls.
Yeah, and that last point is very important as well. I hope that you heard and found useful the conversation that I just had with Raj from PPFAS, and he said that they have often over the course of the last several years done this, and they have communicated it to their unit holders as well. But it's not just them, right, Kirtan? There are so many funds that have currently taken that cash call. You have certain data on that.
I think yes. Talking about PPFAs first, very honestly, there are two funds that I've been tracking for a long, long time, and these fund houses often take cash calls and they make it a point to communicate, which is PPFAS and ICICI. I saw them doing very similar in 2020, and I saw a lot of funds do this in 2008 as well. To give you some data, I was looking at. I think keeping a cash of 3 to 5% is pretty normal, is because when you have 3 to 5%, you want that kind of cash to make sure that if at all there are some redemptions coming up, you have enough liquidity to make good for the payments. But if you have beyond 5% as cash in your portfolio, this is surely a tactical bet that you are trying to take, where you think that the money that you have is not investable at this point in time. I was looking at some data at the end of September, and there were close to 18 schemes, 18 equity schemes, which had more than 10% of cash at the end of September. And there were 106 schemes which were holding more than 5% cash. And this was across multiple AMCs. But I think PPFAS and ICICI, two AMCs that in my last 14, 15 years of doing this and tracking, I've often seen them take cash calls.
Okay, that's a fair point. The other aspect is, and I've wondered this, Kirtan, of course, maybe I will ask a few more fund managers what they think about this, is that if you've gotten used to it, and I'm going to draw an analogy, maybe it'll make sense to you and you can comment on it, okay? If you've gotten used to taking the bus every day and you know that the bus is going to be late, you will take the opportunity on a few occasions to, get to the bus stop a little late. But if the bus has gotten much faster and is on time and perhaps even ahead of the time, then you're going to miss the bus. Is that the case with the Indian equity market?
I think, Alex, look, like I did mention to the last comment also that we were discussing, my problem here is that there are 2, 3 moving elements, Alex. First, we are missing out on the entire equity piece in terms of liquidity that is getting pushed in by the retail investors. Both of us know that probably 95,000 crore worth of FIIs have sold money and equally DIIs have bought, right? So a lot of cash that was sitting at the end of September has got deployed in October. Now the problem is at the levels at which new SIPs are coming in, and the majority of the retail investors who's buying every small dip that you are seeing in the market, this cash is only going to keep increasing at the mutual fund level, is my understanding, because of new lump sum investment coming in and new SIPs or continuation of the SIPs that is happening. Now, if this situation is only going to be even bigger of a problem going forward, because more and more retail investors will come in, I am slightly skeptical of how quite often will you really be able to take this cash call, because I've been hearing that the markets are expensive, and let me tell you, I do believe that mid small markets are, let's say, expensive, but how often will you not do anything with the cash that is coming in? Because the best way to do this is stop taking new money in the fund, which not a lot of other funds are doing. So what you're doing is you're not stopping to take new cash in the fund, but when the money comes in, you don't know where to deploy, and hence you are standing cash. I think if you're able to draw a line between this, I think that's the right way to move forward. But like I said, if a fund's objective clearly states that you are okay with taking cash calls, I'm okay if the fund manager is taking cash calls, because that's communicated and investors should know about it. But if there are funds who are not communicating and taking cash calls, that's something that I'm not really okay with.
that liquidity factor is absolutely key, Kirtan, because I can't remember a month in which you've seen 90,000+ crore of selling by a foreign institutional investor cohort where you've seen the benchmark fall just 6.5%, where you've seen that velocity and volume of selling. But there are several queries that have come through, Kirtan, and I want to take the first one from Shakib, who's written in. He's 21 years old, and I'm glad that he is starting his investment journey so early. He says that he wants to start his investment journey with a 10,000 rupee SIP and a 10% annual SIP. His time horizon is 25 years and he's got a moderate risk appetite. What fund should he consider investing in? Because it's a very long-term horizon.
I think, like you rightly said, I'm really happy that young investors are coming in, and congratulations, Sakib, for deciding to start your SIP journey. There are two things that I am very keenly looking at here. I'm very happy that the investor is educated enough to understand that he should do a 10% annual step up. So many congratulations on that. And at the same time, the time horizon is very interestingly large at 25 years, which is brilliant. But because the investor has a moderate risk appetite, I'm not sure how strongly a small cap fund would fit in, because in a general context, if you have a 25 years of investment horizon, I would have really loved to recommend a small cap, but because he is moderate risk, I am trying to avoid. I think you can split your investments across SBI Contra, ICICI Large and Mid, and Kotak Emerging, by which you will equally spread your investments across large and mid, which is good for a 25-year of investment horizon. And I'm slightly restricting myself to do anything on the small cap because you've mentioned that you don't want to take aggressive risk.
Which is perfectly fine. And I'm glad that he's cognizant of his risk-taking ability as well, which is another sign of maturity. And kudos to you, Shakib, for having that thought process. Arun, who is 25 years old, not too much older, Kirtan, and so therefore congratulations to Arun as well. He says he's a state government employee and his goal is wealth creation. He's probably not thought about what he needs the money for. His time horizon is 15 years. He's got a few stocks that or rather a mutual fund scheme that he's invested in. UTI Nifty 50 Index Fund, the DSP Nifty Next 50 Fund. He's got the ICICI Mid Cap 150 Index Fund, the Small Cap 250 Index, Motilal Nifty 50, Motilal Nifty 250 Micro Cap Index Fund, and the Parag Parikh Flexi Cap Fund. The only actively managed scheme is the fund manager that we spoke to today. Everything else is in the passive space. Would you suggest that he change anything?
I think I'm glad to look at diversification across market cap. He's very smartly put money across everything which was possible from the Nifty to the micro cap index. So I think he's done a great job. My only suggestion will be, if you have a 15-year of investment horizon, and because he's not mentioned what's his risk appetite, and I want to assume that because he's got 15 years, he probably might lose out on a large opportunity, and hence suggesting to reduce a little bit of large cap, because across UTI 50 Index, DSP 50 Next Index, and PPFAS, he has a lot of exposure to large cap. So if you can reduce a little of large cap and spread that across mid and small, it'll be great.
Last question, quick one. Elamaran, who is 31 years old, is planning for his retirement. He's planning to start investing 5,000 each in large and mid cap 250 index and multi-cap fund. Is this a good combination? Large and mid cap 250 index and a multi-cap fund. What's the view?
I think I would rather suggest that you go for large, mid, and small separately. Historically, an equal weight portfolio in large, mid, and small has done much better on risk adjusted. So versus what you're suggesting, I would suggest do large, mid, small, independently and equally invest across them.
Sorry. I know that you have this view, 1/3 each in the various market capitalizations, and you've pointed out in the past as well that it has done incredibly well. Kirtan, as always, absolute pleasure having you on the program. Thanks so much for taking the time.
Alex, thank you so much for having me.
All right, that brings us to the end of this edition of the Mutual Fund Show. Hopefully it's been an insightful one for you. Do let us know what you think about this program, and if you've got specific questions about mutual funds, then you can send them on that number that you see flashing on your screen. It will eventually come to you. But do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.